This conference will now be recorded.
There you go. So, part of our COVID latest and greatest update, we're going to dive into the latest information about the HHS reporting requirements as it relates to the distribution rounds for the Provider Relief Fund. We'll cover who is impacted, the key dates, and the clarification with regards to expense and lost revenue reporting. And then, as we'll wrap things up, we're going to cover the latest update on the PPP tax implications. So there is a lot to cover. It's going to hopefully not take too much of your time, but we want to be sure to get it done. So Mike, I will hand it over to you.
All right. Well, thank you, Aaron. I appreciate it. And let me go ahead and disappoint everybody on the call kind of going into this. There's going to be a lot of times in this discussion where we're going to go, we're not entirely sure where they stand on it, because I think there's no doubt this is an evolving discussion, and there's going to be questions that you're likely going to ask where our answer is going to have to be, yeah, we'll go find that out for you, but we don't definitively have an answer right now. So we'll get going. This is a good bit longer presentation than we've been doing, so we'll move through it as fast as we can. All right. So I have shown you all this slide before. This is the who has to do this, which I'm quite certain that the answer is going to be everybody on this call. But if you've gotten more than 10,000 from any of the general distributions, and then for the hospitals, the targeted distributions, then you're going to have to meet the reporting requirements. There's some other requirements if you got over 500 and then 750,000 that we'll talk about that involve the amount of supporting documentation to give. But if it was over 10,000, you're going to have to report under the mechanisms that we're talking about here. Next slide, Aaron. What little pieces of it don't apply? There's not much. That nursing home, infection control, RHC, testing, distributions, and then I think some of y'all got some of the HRSA uninsured money. It's probably not impacting whether or not you clip $10,000 or not, but those things are excluded from the process. Next slide. Key dates, and this first one is increasingly important as the lack of clarity kind of becomes real. The website opens January 15th. Your reporting through 12/31/2020 is due by 2/15/2021. And then if you need to, which I would expect most people would, if you need to then report again for January through June 2021 activity, that will be due by July 31st, 2021. And we'll talk a lot in just a bit about, I think there's a lot of reasons why people are going to have to report the second time. But nonetheless, that would be due by July of next year. Will there be extensions available? Yes. There are a couple of websites, and again, we'll have this PowerPoint on our website, like Aaron said, where you can click in and look see what the options are for trying to get an extension. Obviously the timelines on both those two periods are pretty tight, so that would be available. All right, so the next slide. I showed y'all this slide before. The general theory is that it's your provider relief funds minus the general administrative expenses and then healthcare expenses related to the coronavirus. And so it's general type expenses and salaries and stuff like that first, and then other types of expenses that are kind of more directly related to the virus. And then you get down to lost revenues. And you'll see later on that if you're reporting, you have to report both expenses and revenues, whether or not you've used up all the funds in the expense section. But nonetheless, the way they're going to apply it is the provider relief funds you have that are not offset anywhere else minus the expenses, and then move down to the lost revenue section. Next slide, Aaron. Okay, so in general, the attributable expenses are, as I was saying a minute ago, are general administrative, G&A type stuff, and then other healthcare expenses. And with each one of those categories, they are expenses attributable to the virus, not reimbursed by another source. This is where a lot of the ambiguity begins. There's some places in the FAQs that appear to be that reimbursed by another source equals PPP, HRSA, FEMA grant money, and then other places that specifically refer to reimbursement from insurance and patients and things like that. And so as we walk through it, I'll tell you where I think there's ambiguity in there that they're going to have to clarify for a couple of those as we come through it. Because, certainly being reimbursed by patients offsets a ton of this and puts the whole thing kind of in a weird place. And then if you got more than 500,000 in PRF funding in the first place, then they're going to need more detail on those items listed below. And the website has or will have the additional supporting worksheets that you're going to have to turn in information on those particular items down there, mortgage, personnel, those kinds of things on the website if you got more than 500,000. You want, for those of you, mostly physician practices on the phone that got less than that, you won't have to supply any of that extra information. Next slide. All right, so delving just a little bit deeper into the healthcare expenses related to coronavirus, they may be incurred through direct patient care or overhead activities related to treatment of confirmed or suspected cases. Again, remember there was an original assumption that all patients that came to you were way back in the beginning were COVID presumptive. Therefore, that looks like it's been narrowed down just a little bit in here. But it's that direct care activities plus preparing for possible or actual coronavirus, or the costs that you incur in maintaining or expanding healthcare delivery capacity, not specifically related to COVID. As we have talked on previous calls, that it was any activity to maintain access to care during the public health emergency, or really during this COVID time through the 19-20 month period that's going to be from March through June of next year. And so that seems a little open-ended and is one of the points of ambiguity that we're going to need to continue to watch out on some FAQ for. And then the last one, though, it's clear from the FAQs that HHS believes that the expenses attributable to COVID will far outweigh the lost revenue usage. As you'll see as we get to it, lost revenue got pretty prescriptive versus the open-ended versions of it that were in the initial communications from HHS around all this. And so that part seems a little less of an opportunity now, and the expenses side is going to be where the bulk of the identification will need to come from. Next slide. All right, so now boiling down from that, now we're in the general administrative section, which covers the bulk of the salaries. And so the way they've got it listed is that, or the FAQ was, the question was related to what are the allowable expenses in that. And their answer was, in that first bullet point, it's direct employee, full and part-time, contract labor, temporary worker expenses are eligible, provided they are not reimbursed from other sources, which you'll see in the example seems to just be FEMA PPP type offsets. Then it has this other phrase, or the incremental unreimbursed amounts claimed. That phrasing is not defined, it's just in there. And so I'll show you in just a second, the concept didn't make its way into the example, but nonetheless, that is a concerning phrase that's in this. So some considerations that we thought of in there: any compensation forgiven under PPP or FEMA loan will not be eligible for inclusion in this. But y'all remember that PPP is only based on 8 weeks of your salary. And yeah, whether or not you're using the 8-week or the 24-week methodology under PPP to get those funds forgiven, nonetheless, it was still just 8 weeks of salary. And this covers March 20 all the way through June 21. And so, yes, it overlaps. And yes, it's clear now that the PPP dollars need to offset the salaries and related to the pandemic. However, it's a much longer period of time, so that ought not to scare you away from going down this path in the first place. The timeline appears to be the full 16-month period versus the period of the public health emergency. That timing of, making sure that the feds continue, the public health emergency is continued through to January 20 something now, and it gets re-upped in I think in 90-day increments. But it doesn't appear that the eligible expenses on any of the categories are tied to that. It's tied to March 20 through June of 21. Limits salary executive salaries to 197.3, which is the maximum that can be claimed on any given staff member. We did not see an FAQ related to physician salary per se. So our current guess is that that would be limited to 197.3 as well. But I would expect more FAQs around that as we push forward. As I was saying before, reimbursement from other sources appears to be PPP, FEMA, and other grant offsets. And again, this is a little unclear, but by this definition, it didn't seem like it was included the reimbursement for services billed, but again, waiting on more FAQ around that. It is clear, though, that fringes and other benefits are considered to be a PRF eligible expense, not just the direct, the salary cost of the employee. So it's going to be longer than that. Next slide. The example, as I was talking about, now the example, this is the example that's attached to that FAQ. And you see here that it seems to take the full salary related to those positions there and then removes the amount that's above 197.3. And then the rest of it is then flows through down under step 2, less FEMA reimbursement, less reimbursement from other sources, PPP, et cetera, and comes down to the eligible expenses. It's clear that it included fringes in that, but it also, under this example, made it look like it was all of the employee comp for that period minus the reimbursement from other sources, which, didn't walk through a second step of, and then show me that, the medical director, 42% of his time was related to coronavirus, responses or anything like that. It's just the totality of the salary. And so again, the opportunistic version of this is that it is that broad. I do think that is going to get clarified as we move forward. Next slide. So the next one, this slide, the question was, when reporting organizations' healthcare expenses attributable to the virus, how do I calculate expenses attributable, not reimbursed by other services? Now, again, the way we read this is this sits below the salary line, and it may include supplies, equipment, those kind of things, even employees in here. So again, it's a point that needs to be clarified. But under this one, it seems to walk through a process of taking the cost, offsetting the other types of reimbursement, including insurance payments and stuff like that, all those kinds of things. And then it comes down to trying to calculate a per visit amount or a per patient touch amount that would be added to each patient visit. But again, as you'll see on our list of kind of questions that are open-ended, the example that they put in there is a $5 increase of expense. And it appears to be an example amount, but the FAQ was pretty unclear as to whether that's a blanket amount that would be allowed, where it's calculated. And if it's calculated, then I don't see any guidance of how you get from the overall calculation of the expenses that are eligible down to that per visit amount. And so, unfortunately, again, I think there's a little bit more homework that's going to be involved to get to that point. The next slide are some examples around this. And, again, all they're really doing is saying that, well, if Medicaid paid you $5, then the assumption will be that there's an extra $5 attributable and that you were in essence underpaid for the treatment of those services. Therefore, you're going to get to claim $5 as an attributable expense for this. And that's kind of true of all the examples that go down the line there. So again, not entirely sure if that's the Fed's going to give us a number and just say every patient touch, we're assuming a $5, COVID inefficiency, or if that's a calculated amount on top of it. Anybody have a question about that?
Mike, there is a question in the chat regarding, it says, if I'm doing in-house COVID testing and being reimbursed for these tests by insurance companies, those testing supplies are not an eligible expense. But if I had to purchase equipment to run the test, is that expense eligible?
Yes, it is. It's not in this section. Mike, that answer would be, it's going to be covered down in the equipment section in just a second. But the short-term answer is that if it's an piece of equipment that you bought specifically to treat COVID patients, 100% of that is allowable. If it's another piece of equipment that was just to maintain access to care, it's depreciation only. But we'll come back to that in just a bit. Next slide. All right, so continuing down the path of the other healthcare expenses, I guess was the relative point out of this is that you first calculate your expenses for 19 versus 20. And the idea is that you're taking the change year-over-year expenses, and then underneath that, identifying the portion that's attributable to the coronavirus. So the example down there below kind of gets at this. For 2019, the PPE supplies were 1,000. 2020, it was 4,000. So there's a $3,000 difference. And then even when you get down to the $3,000 difference, you're then applying a factor to say what portion of that increase is related to coronavirus in the first place. And that you come down to that 2,500, and then how much of that was reimbursed, and now you're down to the remaining balance that you can claim. Now, obviously, that is a much more in-depth process than the example that they provided for salaries. And so, it's unclear whether or not the salary portion is supposed to flow through a similar thought process as that. Our hope is that it doesn't, but I don't really see the connection to that. B, this process means that in order for you guys to kind of come up with this, I would envision that you're going to have to pull your 2019 versus your 20 and your calendar year of both these. Your 2019 versus your 2020, I guess if it's not, if we're saying non-salary for purpose of this example, then it's non-salary expenses, and then take the increment on that, and then from that apply a factor to the differences, and then from that calculate the offset and reimbursement, and then whatever's left over. It just feels like this section, there's a lot of work to be done, and feels like it's going to come down to a fairly small number if they include reimbursement from insurance billings in that as well. So this one, I get the example, but it seems like there's still got to be some more clarification around it. Next slide. This slide was just kind of to summarize our largest kind of open items that we're fearful of in this area. So the first section, as I was saying before, it appears to either allow for all salaries or at least all direct clinical salaries. The only reason I say that is, and I forgot to mention this earlier, is in the example they gave, although it's under the general administrative expense section, the example was a medical director, nurses, and security, which seem to be areas that at least touch patients or would have something to do with the quality of care being provided. The example didn't include the business office, accounting, finance areas, all those kinds of things that are not directly touching patients. And so the example appears to allow for either all salaries or direct and slightly indirect clinical salaries, less PPP, FEMA, HRSA reimbursement. And we need to clarify whether or not other reimbursement is going to be offset on the salary section itself. Also, for salaries and benefits, there's a reference to eligible expenses being not reimbursed for only other services. And yet that sentence or that phrase I was telling you before about only the incremental unreimbursed amount. Well, if that is the signal that it's supposed to go through a similar worksheet as the PPE example a minute ago, then obviously our ability to get eligible expenses out of that is going to drop drastically. And so that needs to get clarified. The third bullet point there in the other expense section, how do we report eligible expenses at all if a profit was reported? And in theory, if the expenses are fully offset by insurance reimbursement because you had a profit, you may be year over year losing more or making less money than last year. However, those expenses are still fully offset. Therefore, do we have anything to claim? And that needs to be offset. And then how do we translate the other expenses, as I was saying before, into that per visit add-on? Or is that a flat amount that everyone is going to be, sort of equally be given the ability to throw into the mix? All right, next slide. So this is kind of getting back to the point that was thrown in on our chat. So when you look, there's a couple of FAQs that are kind of clearly address the point about capitalizable items. And the question was, is everything, if there was a capital item that meets the eligibility requirement one way or the other, do I fully get to claim it, or is it just the amount of depreciation? And the answer is in two buckets. And from this one, you can fully expense the item purchased when the purchase was directly related to preventing, preparing for, responding to the virus. And they gave examples in here of the HVAC, retrofitting a COVID unit, those kinds of things, leasing temporary structures, et cetera, et cetera. And so those can be, regardless of the fact that you may have depreciated them for 10 years on your books, those are fully claimable now. Go to the next slide. This slide is essentially answering the same question, but it had different examples. And so same as before, the question is, when can you fully expense it? And these are other examples: ventilators, masks, biohazard suits, general PPE kind of stuff that's equipment that might have been capitalizable on your books, those kinds of things. Those are fully expensable to a virus expense in this reporting, regardless of whether or not you capitalized and are depreciating it. That seems pretty clear. The question up above about the 1.5 years depreciation really is better explained on this next question. So go to the next slide, Aaron. So everything else that, as I was saying before, all the way back at the beginning of the PowerPoint, if it's not an HVAC that was on the COVID unit, but there are many, many other examples that we have talked about before of capitalizable investments in your facility that are more for maintaining, that will qualify as maintaining or expanding access to care for your hospital. And an example I'd given before is that, I need to get the roof fixed because it eventually might impact our access to care if I don't do something about that over the next year or two, and I might have to shut the unit down. Several examples like that. And they have clarified that those items that are not directly COVID related, but are more related to maintaining or expanding access to care, that what you cannot claim the full amount, you can claim the depreciation that you would have booked normally from March 20 to June 21 for those. The only exception to that is if for some reason you have an item that is capitalized but has a useful life of 12 months or less, then, and that's how you would have booked it normally under your current accounting policies, then you can fully claim that within this period. Next slide. So a couple other kind of tangential points that go along with this. Is sort of the way that it was phrased was the hierarchy of funding offsets, which is to say that if I come up with an eligible amount of dollars to be spent that are eligible under the HHS guides, what all do I have to, what of the other funding offsets come first before applying to the HHS provider relief funds? And the answer is pretty much everything. And so any other grant monies you got, FEMA monies you got, all those kinds of things, basically including, direct billing, insurance, at least for these other expenses, all of that in theory under this question comes out first before you come down to the net remaining eligible expenses that are applicable to the HHS funds. And so again, key question underneath that is, if it's exactly as written here and we're having to offset all direct patient billing and all commercial insurance and all Medicare, Medicaid reimbursement from the mix of this before we get down to the net eligible expenses that for which we can apply PRF funding, then it would appear to be you would have to be losing money to even be in this position in the first place. And that if all those reimbursements, including your billing, are offsetting the cost in the first place, do you have anything to claim toward the HHS funds originally? And by this answer, I would be pessimistic. But like I said, there's conflicting answers that are within all this, and I strongly suspect a lot of that's going to get clarified. Next slide. So shifting from that very confusing discussion about expenses that I know left you with more questions than answers over to the lost revenue part for right now. There's several clarifications that have occurred since the last time we've talked as well. The first of which is that highlighted the bolded part there, that in the original version of this, lost revenue was defined really as 2020 revenue minus directly attributable expenses, like a contribution margin number, a $1 million of revenue minus 600,000 of direct cost to serve those patients, down to 400,000, and then compare that net number to last year. They took out the requirement to net the direct healthcare related expenses against patient care loss revenue. So the whole idea that we have to go through our income statements and break it up into direct versus indirect and then net down the revenues, that's all gone. So it's as we'll get to in the next couple of slides, it's a 2020 full calendar year net revenue or collections if you're in a cash basis practice versus a 2019 version of that number, and that net number is it. That's the number we're going to be playing off of. Next slide. This gets into it a little bit more, and it's really the last point is the most relevant one in here. Again, it's saying what I just said, that it's full calendar year 2020 versus full calendar year 2019. So really it's 2019 minus 2020 minus 2019. And if that number is a positive, in my example, 2020 minus 2019, then you really have nothing to claim. If it went down, then you do have something to claim. And that last bullet point, which was in the FAQ, is kind of the most relevant. Recipients that reported increased revenue from patient care in 2020 as compared to 2019 are eligible for PRF payments toward expenses attributable, not reimbursed by other sources. However, they would not be considered to have lost revenues attributable to the virus for the initial reporting period, which is to say that, yeah, you have the expenses that you might have occurred that are eligible based on all the other slides we were just looking at. But in this section, if your revenue in total entity-wide went up year to year, then you're not eligible for any lost revenue, even if you dipped during the March, April, maybe early May, all those timeframes. Even if you can demonstrate a dip in those timeframes, it's a calendar year to calendar year comparison. Next slide. A couple other points with this, which I think gets to one of our, one of our embedded issues with this. Can I use 2020 budgeted revenues as basis for reporting lost revenues? Well, the answer is no. Basically, your projection is irrelevant as compared to this. It's going to be 2020 actual to 2020 or 2019 actual. And you'll see on their questions later on, one of our problems that we have at this, we have several of y'all who were in the position in 2019 and early 2020 where you added a service, you added a physician, you had a general uptick in your volume. And so to say that it's 2020 in its entirety versus 2019 in its entirety, when you were on an uptrend anyway, is not a valid comparison point. but I don't see a clarification that accounts for that. There's no apples to apples, as if that new provider or a new service is not in the mix and then compare the two numbers. It's just entity-wide, year over year, and that's it. So I hope that gets clarified. I hope there's more opportunity in that, but it unfortunately looks like it's just very straightforward. The next bullet there, will the same lost revenue comparison apply to the first 6 months of 21? And we've answered this before. The answer is yes. And the comparison point will be January to June of 19, not 20, January to June of 19 versus January to June of 21. And so, yes, that opportunity is still out there. But again, it's entity-wide, 6 month period over 6 month period is where it sits. Next bullet. Next slide, I'm sorry. The next slide kind of gets into, there was a question about what's considered to be total revenue and included in all that. There's really nothing that's, I think I had said on a prior one, you go off of the accounting methodology that you're on currently. If you're accrual based and you're doing a reserve calculation and you're coming down to a net revenue number, that's your methodology. If you're a practice that is cash based, then it's year over year cash basis. So it's whatever your existing accounting methodology is. You don't get to play the game of I'll try accrual versus cash based in both years and go back and forth. It's whatever your existing reporting is under now. It contemplates that's what's going to be under for purposes of this reporting. And so walking down the various payers, it's exactly what you would expect, that it's, if you're cash basis, it's actual revenues. If it's accrual based, it's a net charge of whatever you're coming down to as your methodology for that. And then all of it should be reported net of uncollectible patient service revenue recognized as bad debt. And so on the hospital side, it would be net revenue. And if you're reporting bad debt underneath that, you'd have to net that out for the 2 years. If you're a practice that's cash based, you're not really dealing with bad debt expense per se. And so it's just collection over collection. Next slide. All right, so this is what I was saying earlier, which I think is what's so kind of unfair about where it sits right now. In the instance where new providers, new services were added, it doesn't seem like it gives any credit for upward trend interrupted by COVID. It's only a year over year unadjusted. And to me, the FAQ we ought to throw in is, will they allow for some kind of adjustment for changes in providers, location, services, et cetera, that would account for that. And then the other one, which is kind of a corollary to the first one, the lost revenue calculation is at the entity total revenue level. And so if there are services that you provide that were sort of naturally more not interrupted by it, and yet there were others that were shut down completely by it, will there be any allowance for that? It's really not a house-wide answer, and for us to be able to look at it in pieces like that. And there's absolutely nothing in the FAQs that addresses that now. It feels like a long shot to me, but I feel like the question ought to be posed whether or not there's any allowance to drop it down to the specific service level to get any clarity on that. Next slide. I was mentioning this before, but what this is basically saying is that in any period, if you choose to report, everybody's got to report by 2/15 for the 2020 stuff. But if you choose to report and you feel like you've fully justified your money on the expense section, you still have to report the revenue section. And if you need the first 6 months of 2021, if you choose to report there, again, you have to report both sections there, regardless of whether or not you think you just need part of it to justify the dollars that you've got at play there. Next one. There is still some clarity outstanding on this point as well. However, I had thought previously, and I think I have reported previously, that HHS provider relief funds were to not offset cost report expenses. However, there's this odd sentence that's in one of the FAQs that says, in these instances, if the full cost was reimbursed based upon this method, which is the cost reimbursement method, there's nothing eligible to report as an expense attributable to coronavirus because the expense is fully reimbursed by another source, which I'm interpreting to say if I incurred $1,000 worth of expenses and the HHS funds offset that $1,000, that it's saying I don't have a cost reportable expense to claim in the first place. And so more clarity is sought on this, but that sentence would lead me to believe that that is, if you're familiar with the cost report mechanism and A8 offset. I should have said this going in, but the point I'm making now is completely related to the hospitals. And so if you're a CSB or you're a physician practice on the phone, this point is irrelevant to you. On the practice side, you still have the fact that HHS funds that you retain are ordinary income and taxable to you, but this issue is not relevant to you. Next slide. Supporting documentation and records retention. No external documentation was required at the time to support. You don't have to submit all of your payroll records, all that kind of stuff. There are supporting worksheets that'll make you put some more detail in for those who got more than 500,000, as I was saying before. But it will just be specific. It appears to just be specific numbers without, specifically uploading the underlying supporting documentation for it. And then how long do you have to keep it? And it's 3 years after the date of submission in accordance with that ruling there. Next slide. For those of you that got more than 750,000, which would be most of the hospitals, or yeah, I believe all the hospitals on this call, and then just a couple of the practices, you'll need to arrange for a single audit to be done. And so there's a little additional clarification about under what type of single audit and under what regulation that's going to be required. And so you see for non-federal versus commercial entities that it's two different places in the regulations that are going to govern the single audit. But nonetheless, if you got more than 750,000, you're going to need to arrange for an audit of your submission in the first place. And so again, that will be an issue out there. And then switching from that, next slide, and I'll come back to the couple of questions that are there. One kind of non-HHS reporting update is that in the last 6 days or so, the IRS has issued another revenue ruling, which has made it absolutely clear. And again, from this perspective, CSBs, hospitals, this is not really an issue for you. This is more of an issue for the independent practices that are on the phone, that the guidance is now far more clear that taxpayers that got a PPP loan, that those expenses that are offset by the loan are not deductible, whether or not you have your letter in hand or not. If you reasonably expect to receive forgiveness, then it's not deductible now. We had been saying before, there might be a little game to play as we were hoping the Senate would clarify this at some point when round 4 came around. But for right now, it seems to have closed that loophole such that whether or not you have your forgiveness letter in hand or not, that if you expect for full forgiveness to occur, or to the degree you expect forgiveness to occur, the offset expenses are not deductible, which again is tantamount to saying that the program generates ordinary income for your providers and so your owners. And so that's bad news. And it doesn't appear that that's going to get, clarified in time to affect this year's tax filings. And so unfortunately, that I think is where we are. And so for everybody, we've been telling, slow go the forgiveness because it might help you with the tax implication of it. I think we just got our bubble burst. All right, so all that said, I will pull up the questions, but first I will ask Kelly, do you have anything to add to anything we're talking about?
No, Mike, I think that covered the interpretations that we had.
Got it. And all right, so I got one more question for net revenue. How do we handle a discontinued line of service for FY 2020? Now, this is where I think you're going to artificially benefit from their overly high level methodology. If you're in a position where you dropped providers or discontinued a line of service, there's not a mechanism to apples that either and make you report the 2019 revenue without that line of service. And so it's still house-wide to house-wide. Therefore, it appears that you would get credit for that in the midst of all this. And for those of you that kind of serendipitously are in that position, congratulations. That may be you're out with all this. And the last question that just came in is, are we going to update our worksheet for these changes? Yes. Yes, I feel like there's some clarity on half a dozen points that would really be helpful before we codify this down into a spreadsheet. I still fully recommend that everybody attempt to lay down their 2019 versus 2020 full year projected revenue, calendar year, not your fiscal year, and your expenses for that, such that you can look at if it is all salaries, then okay, how much does that cover? If it's not, year over year, and then walk that through that same calculation as the PPP example in the PowerPoint to get down to a point of having a sense of what you will have eligible and what's not eligible out of what you got. And so I know that's really vague. I know that that's more kind of futuristic, and we need to kind of lay out some more concrete guidance around all that. But nonetheless, the answer to the question is yes, we'll do that. Yes, we're desperately waiting on some more FAQs for more clarity to do that. And then regardless of that, in another few weeks, we need to have another one of these sessions and walk through where we think we are. And then hopefully at that time, Marty, we'll have a version of a worksheet to show you that walks through this. Great question. Thank you for that. Any other questions? All right. You see the next one, December 18th might be a fine time to do a refresh on this based on whatever new FAQs have come out, but here are the upcoming webinars that we have out there. And so if you're leaving here kind of disappointed, don't say I didn't warn you, number one. But number two, I think that's just where it is right now. And we'll continue to try to nail it down to as concrete a version of this as we can possibly get down. But trying to be really open with how ambiguous we think it is right now, kind of the open-ended stuff that we see as an issue out there for you guys. Anyway, if there are any other questions, speak now, forever hold your peace. If not, back to you, Aaron.
Alrighty, well, thank you, Mike, and thank you for everybody for attending. Just a reminder, we will be posting a copy of these slides as well as today's recording to our website right there, shp.com/webinars. And we have those upcoming webinars, and if anything comes up between now and what's scheduled, we will be putting it here on our website. So I will give you 15 minutes back to your day. Everybody have a wonderful day and a happy Thanksgiving.
Thanks, y'all. I appreciate it. Bye.